Here's what it is. Here's what it amounts to. It's very simple. This is nothing more than something people do everyday life. They just don't recognize they do it. All it is trying to get the best value of something that you either bought or sold. Bottom line. You'll hear a lot of folks say, well, oh no, investment and trading, that's too much for me. I don't know if I can do it. I'm not smart enough. Yet they do this every single day of their lives. And they don't realize it. Going to work is trading. Going to the supermarket is trading. Yeah, it is. It's just a different way of doing it. See, the thing is when people buy homes or buy something and they know they're going to sell it down the line, do they want to sell it at a price lower than they bought it? Doesn't make sense. You know, if they're going to buy something, they want to make sure that when they buy it goes up in value. So when they sell it, it could, go down in value. So it's something that they're selling that they know that, hey, I got the best deal that I could. No different. Employment's like that. An employer is going to bargain and try to get the lowest price that he can for an employee. As the employee is going to try to get the highest salary possible from an employer. That's trading. You go to the supermarket. Whenever you buy something, you're trading. The supermarket marks it at a certain thing. People go through the line to find the best value. What is cheap? What can I afford? The supermarket wants to go ahead and sell at a premium. Or they'll try to sell as many as they can, so that way whatever it is will make up for the cost of moving the price up. But they've been able to cover enough to cover that risk. It's trading. Everything in life. As long as you expend energy for something, there has to be a trade-off. And that is something that you can go ahead and consume so you could go and continue to expend energy. Whether it's food, whether it's time, whatever it is. The only thing that I've noticed that isn't really energy expense, except for maybe in terms of spirituality, and that's religion. I mean, really, that's you expend the energy, but what is the time value? Maybe feeling good or spiritual consciousness. I don't know, but anything you do in life is risk to reward, and to expend energy to get something in return. It's just the way things are. Trees do it, molecules do it, bacteria, of course, time, weather, you name it. It's all the thing of action, reaction, and then some, for lack of a better term, just very simple physics. Anyways, think of these as little, you can call these bananas, or you can call it employees, or the salary of going to work. You could call it, anything. Now, all these is decisions that people made. They're the same. There's no different than decisions of someone who wants to, go get some food or went to work, or that's all it is just decisions. They were just making trades. The employer wants to get the lower salary, he's going to sell. The employee wants to get he wants to get the lower salary. The employee wants to get the higher salary. He's going to buy. He wants up, he wants down. And so they make a decision as to say, what is the fair value, so that way I can have the best employee, and the employee's like, I could have the best gig. Bottom line. It's no different. You go to the supermarket, it's no different. These are just the decisions that are made. If the decision went down, then of course, think of it as the decision going down is probably in the favor of the shopper. Decision going up is in the favor of the supermarket. So if the price goes up, supermarket is making money. Price goes down, the customer is getting a bargain. That is trading. It's everyday life. People do that. When they start thinking of investment and trading, if they have a 401k, Social Security, they have a insurance, they have everything in life that you do has a certain amount of risk, and somebody is trying to get the best premium, or at least reaching that fair market value between what it costs and and what it's being bought for. Very simple. All this is just basically on a smaller time frame, and you're just, whether it's commodities, Apple, which is what we're looking at right now, or whether it's currency, or whether it's weather, or whether it's interest rates, or gold, or silver, ain't no different than an employee and an employer. No different than buying bananas at your store. No different. It's the exact same thing. The thing is, you want to buy the bananas while they're cheap. And then you just write it up when they're, you want to sell the bananas like you're the store owner. You want to sell the bananas, and you want to sell them up high. The lower you sell, the more the shopper is going to get a better deal. Because if you sell them up here, the shopper has to pay for them up here. You sell them down here, the shopper's like, great. You want to push the price up. So the more shoppers that come in, you can start pushing the price up. The more shoppers that leave the store, you have to go ahead and push the price down so you can, so you can entice shoppers. That simple. It's no different. What these are Bollingers, which is, I have a great trading method for Bollingers. It's like off the hook. I've been using it. I got like corn futures and soybean and gold, which will be used specifically for this, because some of it, depending on the contract size, are really illiquid. So it helps to use something that's volatility based instead of like a range based or whatnot. I like range based, but if I'm using range based or anything like that, I have to use it in like point and figure or something like that. So that way I could just see where the peaks and the troughs are. You won't see a lot of volatility within there. When it's seriously illiquid, I want to see volatility because that'll help me gauge where turning points will be in the future. Now, I had put up a thing earlier about how you could pick, because remember, price in a Bollinger Band, whether it's that, whether it's RSI, MACD, and I'll do each one of these differently. Everything has a thing of standard deviation. The mean or the middle is what I say is fair market value. Over a certain time, that is the fair market value of the buyers and sellers at the supermarket. The supermarket and the customer said, I like this price. Okay, the customer said, that's all I can afford, but I'm going to get this. It's a bargain, but I like that. The general manager might be, well, we'll mark it down. We're going to mark this down. So you might get a better deal here, knowing that it won't affect their cost basis, and they'll still make a profit. And the person who couldn't buy that certain product that they needed knows they're getting a better deal. And it might not be the actual thing, but they got a better deal than what they did, when they walked in. It's just a matter of fair market value. The good market. And that's all this median line is. It's the average closing price, the average settlement value, the average that the supermarket owner that's up here that wants to sell higher, and the underneath, which is the buyer that wants to buy it lower. And all this is just telling you the fair market value of that. When I tell folks, the thing is when I look at certain things, I look at it in terms of standard deviations. You have the mean, the fair market value, and how far from that fair market value did they go. Well, if you know that if it's outside, if it's two standard deviations, you know that 95% of the action of them trying to reach fair market value is gonna happen within. Like, think of it this way. Let me see if I can get a drawing tool up here. I got a different chart up because this is something I've been working on. I've got all kinds of charting packages that I use because I want to see if the constructs and the data that I use are exactly, no matter what package I have, are they the same? And I've noticed that it is. Okay, and that's the good thing that I like is no matter what I use, the packages or the data is going to be the same. It's going to be very, very similar. Ooh, okay, let me do that again. So this package is a different package. Let me do that because, knowing me, it's kind of hard to talk and do this. So we'll try the boxes. Okay, there's one box. Okay, let's move this box up here, or can we? Oh, I guess not. Okay. Anyways. Okay, let's try a line. let's see, maybe I got the wrong thing here. On what average is. I want something I can draw. Geometric, that's what I was looking for. Quadrilateral, rectangle, that's what we want. Okay, so we have a rectangle right here. Okay, fair market value. The whole aspect is to try to get something at fair market value, at the best value that you can get. Think of this rectangle as maybe a widescreen TV, and I think I've taught this before many a time. Think of it as a widescreen TV or something of that nature. And you go and you tell your girlfriend, wife, husband, whatever. Somebody goes to, they said, I'm going to go get this, 6 foot, wall to wall, 4K, monitor. I mean, it's the best of the best, and I could find it for, say, $150. And somebody that's like, oh wow, this is, it's the size of your wall for $150. I mean, it's a pretty good deal at this particular time. Remember, value changes in time. In 5 years, it'll be probably worth, 20 cents, at the rate of technology. 10 years ago, it'd probably be $10,000. So the value, like this value in these median and this middle line, changes over time. So the thing is say somebody leaves home, they tell their spouse, I'm gonna go get that for $150. They get to the store, and the store owner goes, he knows that he can, he's trying to sell it for $200. That's, he knows, I know I'm gonna get in the upper range. Your bottom price is, say you want to buy it, your starting price is $125, because that way you can get to $150. All of a sudden, you guys are bickering back and forth, making a deal or whatnot, and you know that you're going to start out at $125, but you know you're going to end up spending $150. He wants to start out at $200. He knows that that's the level at least he's going to start out with. You have an upper limit that you say, I can't go over $150. He has a lower limit that says, I can't go under $150. So you make that fair market trade. The thing is, you walk home, you get ready, and you tell your wife, husband, or whatever, and you say, look what I got. I got my price. Or maybe you got it for $149. Or maybe you got it, underneath this price, $135. Maybe, you were able to get it at $125, at whatever. You got it at your price. Doesn't matter. The thing is you walk home, and you get the thing delivered to your house, and you find out, I got it. I made the best deal. But your wife or significant other says, did you check the paper? Other stores in the area are selling them for $25. I know it's one of those moments where one wants to kick themselves, and I caution not to be in any hotel rooms over 3 floors, because it might propel someone to do something that's not recommended. What it is it's a thing of knowing where these are valued. Well, what I use is knowing that if inside this right here is going to be 98% of the price, anything that goes over this rectangle is 95% over here. If 95% of the action is in here, I know that outside of the action is only going to be 2.5% outside of this action. So I know if it contains a gang load of the price here, I know anything that hits this top line is going to want to go back. And knowing the laws of action reaction or buyers and sellers, it will go from this line down to this line most of the time. It'll try to reach this line most of the time. There are times when it'll get to this line and will only go to the center. A lot of it, the reason is because the center is fair market value. That has a lot more percentage, but at least I know a lot of the time it will try to hit this line and then go back, and they just go back and forth and back and forth. But in order to get to this line down here, it definitely has to go through the center. So the center is going to, no doubt, get more action, irrespective. Okay, I should clarify what I'm saying. Yeah, the center gets most of the action, irrespective, because in order to get to the bottom line, you got to go through the center. It's that center. I mean, it's that simple. Anyways, the methodologies that I use, and I showed one about using pitchforks and using Bollinger Bands. If you know that 95% of the price is going to be within here, and you know that using a pitchfork, 80% of the time when you use your forks, or the median line, I use median lines, I don't use forks. There are methods that you can use a fork. For me, just using the median line alone is just, it just makes it a lot simpler. Let's see if we can find a median line. Let's see. It's in here somewhere. Let's see. It's not cycles. I think it's geometric again. Yeah. There it is. So if you're using a median line, and this is going against the trend, you have median lines that go with the trend and against the trend. The reason it's going against the trend is because your A point on an uptrend is not the highest point. I mean, not the lowest point. If it were going with the trend, the A point would be the lowest. If it's a downtrend, the A point would be the highest. If the A point is in between B and C, then it's always going to be a retracement. That's just the way it is. Now, let's see if I can change this median line, and and let's see if we can edit this. Levels, I guess not. I thought I could. Let's see, baselines. Median style. Median line only. Okay, there we go. I thought so, because I used this before. There's our median line. 80% of the time, price is going to want to touch this median line after it goes to this point right here. Of course, it went way, way up, but what did it do? It went back in. I remember showing everybody that on it was a long time ago when I was first really when I was doing all the sessions, just showing folks that 80% of the time price is going to want to touch that median line after it goes from the C point. Here's the A, B, C. What did it do? It invariably fell there. Why? Because like the rectangle, it goes outside of a certain, where those standard deviations, because that's all the C, the B and C point are the furthest out the rectangle you can go before it goes back in. That's all it is. And so I use that in order to do this. Well, you don't only have that perspective. You also have the other perspectives of sentiment, volatility, the time, the volume, and other things that also go outside of standard deviations to go back in. And it's so easy it hurts. But what I'll do is I'll put this on this is enough for the quote unquote public version. I'll put the private version on my page on the Garvey site over at Hotep Traders, because the thing is it's not about, again, this is just about increasing our value. Okay, and our value, think of it as risk. Again, you're at the store. If you're buying stuff and it's being marked up by the supermarket, they want to make sure their loss is think of 1R, or the risk, or the loss, or, the thing that they know that I can't lose, like the guy that sold the TV. He's like, I can't go over this price. Every so much over this price is going to be a loss in dollar terms, time terms, sentiment terms, terms of when he has to explain to his wife why he, had sold a gangload of TVs and didn't make $1, and, they can't go to the movies next week, The thing is that's what you're willing to lose. Or if you're the buyer of a product, if it's over that price, then, your wife's going to look at you crazy and say, hey, you could have got a better deal, but you paid too much, and every dollar or every $5 or whatever your risk was over that is going to be your R value. The systems or the methodologies, all these decisions is helping you decrease your R and multiply whatever that is in your favor. Here's what I mean. If you have a risk of losing $1, you want to make sure that you win or have $10 for at least that one little bit of risk. Then that adds to your expectancy. If you're only 50% of the time that you go out to buy that TV or buy eggs or try to get, gigs, even if you're only 50% successful, you're ahead of the game, because for every 5 losses you have 45 wins. Okay? You're losing 1 to make 5, basically. And I hope my math is not twisted. Brother Allen, help me out with that, because it's very late. And I've been listening to a lot of cool gospel. It's a lot of cool chord changes that I'm trying to learn. Anyways, once you do that and you figure out that all these are decisions, it's not about trying to have the ultimate, even though a lot of things I develop are pretty intense and they will increase your R value, and I call them grails because they really are. I mean, if you've got an 11 to 1, I had a 13 to 2.5, so it was almost like 7, I was like 7 to 1 R value. In other words, I make 7 for every one I lose. And that was last weekend. Okay, right now on this other thing, I think I'm up like 15 to 1 R values on 4 different securities that which are stocks, if you want to call it ETFs and whatnot. This week will be futures. I'll be doing a lot of futures trading as well. But as long as you have that and you start thinking in terms of it's not really about money. You start thinking in terms of like you're going to the store and you want to make sure that you have an inventory, or you want to get more from the store than, for a less price than what they're trying to sell it. Or if you're the store manager, you want to get more in terms of price, in terms of making money. You want to get more for what you're selling. So hopefully this helps.